After studying this module, we shall be able to know various financial management decisions and the risk-return trade-off. Identify the role of finance managers in an organization. Understand the structure of finance function in an organization and learn about the agency problems.
To begin with, let us start with the decisions involved in financial management. Financial management involves taking capital budgeting, capital structure, dividend decision, and working capital management decision.
Investment decision or capital budgeting decision. This decision relates to careful selection of assets in which funds will be invested by the firms. A firm has many options to invest their funds, but firm has to select the most appropriate investment which will bring maximum benefit for the firm. And deciding or selecting most appropriate proposal is investment decision. The firm invests its funds in acquiring fixed assets as well as current assets. When decision regarding fixed assets is taken, it is also called capital budgeting decision. Factors that affect investment or capital budgeting decisions are: number 1, cash flow of the project. When a company is investing huge funds in an investment proposal, it expects some regular amount of cash flow to meet day-to-day requirements. The amount of cash flow an investment proposal will be able to generate must be assessed properly before investing in the proposal. Number 2, return on investment or ROI. The most important criteria to decide the investment proposal is rate of return it will be able to bring back for the company in the form of income. For example, if project A is bringing 10% return and project B is bringing 15% return, then we should prefer project B. Number 3, risk involved. With every investment proposal, there is some degree of risk which is involved. The company must try to calculate the risk involved in every proposal and should prefer the investment proposal with the moderate degree of risk only. And number 4, investment criteria. Along with return, risk, cash flow, there are various other criteria which help in selecting an investment proposal, such as availability of labor, technologies, input, machinery, etc. The finance manager must compare all the available alternatives very carefully and then only decide where to invest the most scarce resources of the firm, that is, the finance. Investment decisions are considered very important decisions because of the following reasons. Number 1, they are long-term decisions and therefore are irreversible, meaning once taken they cannot be changed. Number 2, they involve huge amount of funds. Number 3, they affect the future earning capacity of the company. Capital budgeting decisions can turn the fortune of a company. The capital budgeting decisions are considered very important because of several reasons, such as: number 1, long-term growth of the company. The capital budgeting decisions affect the long-term growth prospects of the company, as funds invested in long-term assets bring return in future, and future prospects and growth of the company depend upon these decisions. Number 2, large amount of funds involved. Investment in long-term projects or buying of fixed assets involves huge amount of funds, and if wrong proposal is selected, it may result in wastage of huge amount of funds. That is why capital budgeting decisions are taken after considering various factors and planning. Number 3, risk involved. The fixed capital decisions involve huge funds and also big risk, because of the return comes in long run and company has to bear the risk for a long period of time till the returns start coming. 4, irreversible decision. Capital budgeting decisions cannot be reversed or changed overnight, as these decisions involve huge funds and heavy cost, and going back or reversing the decision may result in heavy loss and wastage of funds. Therefore, these decisions must be taken after careful planning and evaluation of all the effects of that decision, because adverse consequences may be very heavy.
Capital budgeting is the process of planning and managing a firm's long-term investments. Finance manager tries to identify profitable investment opportunities, evaluating the size, timing, and risk of future cash flows, both cash inflows and outflows, is the essence of capital budgeting. A finance manager has to find answers to questions such as what should be the size of firm, at what rate should the firm grow, in which asset project funds should be invested, investments in which assets projects should be reduced or discontinued. Now we understand the risk return trade off involved in capital budgeting decisions. Logically, risk is directly proportional to return. Higher the risk, higher the return. Lower the risk, lower the return. This holds true for all investments. A finance manager seeks to select those projects' assets that minimize the risk for a given level of return or maximize return for a given level of risk. Capital structure decision. A firm's capital structure or financing decision is concerned with obtaining funds to meet firm's long-term investment requirements. A finance manager has to find answers to questions such as what are the different sources of financing, how much funds should be raised from different sources, what should be the optimal proportion of different sources of financing in the overall financial mix or capital structure. Different feasible combinations are evaluated and an optimal combination of different sources of funds selected.
The second important decision which finance manager has to take is deciding source of finance. A company can raise finance from various sources such as by issue of shares, by issue of debentures, or by taking loans and advances. Deciding how much to raise from which source is concern of financing decision. Main sources of finance can be divided into two categories. Number 1, the owner's fund, and number 2, the borrowed funds. Share capital and retained earnings constitute part of owner's fund, and debentures, loans, Bonds, etc., constitute part of borrowed fund. The main concern of finance manager is to decide how much to raise from owner's fund and how much to raise from borrowed fund. While taking this decision, the finance manager compares the advantages and disadvantages of different sources of finance. The borrowed funds have to be paid back and involve some degree of risk, whereas in case of owner's fund, there is no fixed commitment of repayment and there is no risk involved. But finance manager prefers a mix of both types. Under financing decision, finance manager fixes a ratio of owner's fund to borrowed fund in the capital structure of the company. Factors affecting financing decisions are: while taking financing decisions, the finance manager keeps in mind the following factors. Number 1, cost. The cost of raising finance from various sources is different and finance managers always prefer the source with minimum cost. 2. Risk. More risk is associated with borrowed funds as compared to owner's fund securities. Finance manager compares the risk with the cost involved and prefers securities with moderate risk factor. 3. Cash flow position. The cash flow position of the company also helps in selecting the securities. With smooth and steady cash flow, companies can easily afford borrowed fund securities, but when companies have shortage of cash flow, then they must go for owners fund securities only. Number 4. Control considerations. If existing shareholders desire to retain the complete control of business, then they prefer borrowed fund securities to raise further fund. On the other hand, if they do not mind to lose the control, then they may go for owners fund securities. 5. Flotation cost. It refers to cost involved in issue of securities such as broker's commission, underwriter's fee, expenses on prospectus, etc. Firm prefers securities which involve least flotation cost. Number 6. Fixed operating cost. If a company is having high fixed operating cost, then they must prefer owner's fund because due to high fixed operational cost, the company may not be able to pay interest on debt securities, which can cause serious troubles for the company. Number 7. State of capital market. The condition in capital market also helps in deciding the type of securities to be raised. During boom period, it is easy to sell equity shares as people are ready to take risk, whereas during depression period, there is more demand for debt securities in capital market.
Now we shall understand the risk return trade off involved in capital structure decisions. But debt is riskier than equity as debt obligations have to be compulsorily met out even if firm incurs losses. Thus, there is a risk return trade off in deciding the optimal financing mix. On one hand, debt has lower cost of capital, thus employing more debt would mean higher returns but is riskier, while on the other hand, Equity funds give lower return due to higher cost of capital but are less risky. Next is dividend decision. In dividend decision, finance manager has to decide what percentage of after-tax profit is to be retained in the business to meet future investment requirements and what proportion has to be distributed as dividend among shareholders. Proportion of profits distributed as dividend is called dividend payout ratio, and the proportion of profits retained in the business is retention ratio. Finance manager here is concerned with determining the optimal dividend payout and retention ratio that will maximize shareholders' wealth. However, the actual decision is affected by availability of profitable investment opportunities, firms' financial needs, shareholders' expectations, legal constraints, liquidity position of the firm, and other factors.
Dividend decision. This decision is concerned with distribution of surplus funds. The profit of the firm is distributed among various parties such as the creditors, employees, debenture holders, shareholders, etc. Payment of interest to creditors, debenture holders, etc. is a fixed liability of the company. Therefore, what company or finance managers have to decide is what to do with the residual or leftover profit of the company. The surplus profit is either distributed to equity shareholders in the form of dividend or kept aside in the form of retained earnings. Under dividend decision, the finance manager decides how much to be distributed in the form of dividend and how much to keep aside as retained earnings. To take this decision, finance manager keeps in mind the growth plans and investment opportunities in mind. If more investment opportunities are available and the company has growth plans, then more is kept aside as retained earnings and less is distributed in the form of dividend. But if company wishes to satisfy its shareholders and has less growth plans, then more is given in the form of dividend and less is kept aside as retained earnings. This decision is also called residual decision because it is concerned with distribution of residual or leftover income. Generally, new and upcoming companies keep aside more of retained earnings and distribute less dividend, whereas established companies prefer to give more dividend and keep aside less profits. Factors affecting dividend decisions. The factors affecting dividend decisions are: the finance manager analyzes several factors before dividing the net earnings between dividend and retained earnings, some of which are: number 1, earning. Dividends are paid out of current and previous year's earnings. If there are more earnings, then company declares high rate of dividend, whereas during low earning period, the rate of dividend also becomes low. 2. Stability of earnings. Companies having stable or smooth earnings prefer to give high rate of return or dividends, whereas companies with unstable earnings prefer to give low rate of earnings. Number 3. Cash flow position. Paying dividend means outflow of cash. Companies declare high rate of dividend only when they have surplus cash. In situation of shortage of cash, companies declare no or very low dividend. Number 4. Growth opportunities. If a company has a number of investment plans, then it should reinvest the earnings of the company. As to invest in investment projects, company has two options. One, to raise additional capital or invest its retained earnings. The retained earnings are cheaper source of finance as they do not involve flotation cost and any legal formalities. If companies have no investment or growth plans, then it would be better to distribute more in the form of dividend. Generally, mature companies declare more dividends, whereas growing companies keep aside more retained earnings. 5. Stability of dividend. Some companies follow a stable dividend policy as it has better impact on shareholders and improves the reputation of companies in the share market. The stable dividend policy satisfies the investor. Even big companies and financial institutions prefer to invest in a company with regular and stable dividend policy. There are 3 types of stable dividend policies which a company may follow. Number 1. Constant dividend per share. In this policy, the company decides to fix a rate of dividend and declare the same rate every year. For example, 10% dividend on investment. Number 2. Constant payout ratio. Under this system, the company fixes up a fixed percentage of dividends on profits and not on investment. For example, 10% on profit. Therefore, dividend keeps on changing with change in profit rate. Number 3. Constant dividend per share and extra dividend. Under this scheme or policy, a fixed rate of dividend on investment is given, and if profit or earnings increase, then some extra dividend in the form of bonus or interim dividend is also paid. 6. Preference of shareholders. Another important factor affecting dividend policy is expectation and preferences of shareholders, as their expectations cannot be ignored by the company. Generally, it is observed that retired shareholders expect regular and stable amount of dividend, whereas young shareholders prefer capital gain by reinvesting the income of the company. They are ready to sacrifice present day income of dividend for future gain, which they will get with growth and expansion of the company. Secondly, poor and middle class investors also prefer regular and stable amount of dividend, whereas wealthy and rich class of persons prefer capital gains. Therefore, if a company has a large number of retired and middle class shareholders, then it will declare more dividend and keep aside less in the form of retained earnings. Whereas, if company is having large number of young and wealthy shareholders, then it will prefer to keep aside more in the form of retained earnings and declare a low rate of dividend. 7. Taxation policy. The rate of dividend also depends upon the taxation policy of the government. Under the present taxation system, dividend income is tax-free income in the hands of shareholders, whereas the company has to pay tax on dividend given to shareholders. If tax rate is higher, then company prefers to pay less in the form of dividend, whereas if tax rate is low, then company may declare higher dividends. 8. Access to capital market consideration. Whenever company requires more capital, it can either arrange it by the issue of shares or debentures in the stock market or by using its retained earnings. Raising of funds from the capital market depends upon the reputation of the company. If capital market can easily be accessed or approached and there is enough demand for securities of the company, then company can give more dividend and raise capital by approaching capital market. But if it is difficult for the company to approach and access capital market, then companies declare low rate of dividend and use reserves or retained earnings for reinvestment. 9. Legal restrictions. Companies Act has given certain provisions regarding the payment of dividends that can be paid only out of current year profit or past year profit after providing depreciation fund. In case company is not earning profit, then it cannot declare dividend. Apart from Companies Act, there are certain internal provisions of the company. That is, whether the company has enough flow of cash to pay dividends. The payment of dividend should not affect the liquidity position of the company. 10. Contractual constraints. When the companies take long-term loan, then financiers may put some restrictions or constraints on distribution of dividend, and companies have to abide by these constraints or restrictions. 11. Stock market reaction. The declaration of dividend has impact on stock market as increase in dividend is taken as a good news in the stock market and prices of securities rise, whereas a decrease in the dividend may have negative impact on the share prices in the stock market. So, possible impact of dividend policy in the equity share price also affects dividend decisions.
Working capital management decision. Working capital management refers to management of firms' day-to-day financial needs. It is concerned with management of current assets and liabilities. A finance manager has to find answers to questions such as what could be the possible sources of raising short-term funds, in what proportion should such funds be raised from different sources, what should be the optimum level of cash and inventory, what should be the firm's credit policy while selling to customers. Let us discuss the risk-return trade-off involved in working capital management decision. Liquidity is inversely related to profitability, that is, increase in liquidity results in decrease in profitability and vice versa. Higher liquidity would mean having more of current assets. This reduces risk of default in meeting short-term obligations, but current assets provide lower return than fixed assets and hence reduce profitability as funds that could earn higher return via investment in fixed assets are blocked in current assets. Let us now move on to discuss the role of a finance manager. Finance manager is the person responsible for carrying out the finance function in an organization. Finance function in a modern enterprise is of permanent and continuous nature. He occupies a key post in an organization and is part of the top management team. He should have theoretical knowledge and practical experience in finance and allied areas such as accounting, economics, statistics, business, and management. Role of a finance manager is today no more limited merely to maintaining records, preparing reports, and occasional fundraising. In modern times, role of a finance manager includes identifying long-term investment opportunities, forecasting fund requirements, fundraising, fund allocation, profit planning, and profit appropriation. Now we move on to discuss how finance function is organized. Shareholders or owners of business elect board of directors as their representatives, who then appoint a top management team headed by Chief Executive Officer (CEO). Chief Executive Officer or the President is assisted by vice presidents from different functional areas of business like production and operations, marketing, finance, human resources. The Vice President of Finance or Chief Financial Officer (CFO) is the person in charge of finance function in an organization. In large organizations, the finance function headed by the CFO is further split into two branches headed by a treasurer and a controller. In small organizations, the treasurer and controller functions are usually combined into one position. The controller's responsibilities are primarily of accounting nature, incorporating financial accounting, external financial reporting, cost accounting, cost planning, reduction and control, internal management reporting, budgeting and forecasting, tax planning and management. The treasurer's responsibilities include long-term investment, capital budgeting, capital structure, financing, financial analysis and planning, dividend decision, management of cash and receivables, risk management, insurance, and pension management. We shall now discuss the various agency problems that may arise in an organization. Agency theory deals with potential conflicts of interest arising in business organizations due to separation of ownership and management. Principal is a person or organization which hires another person or organization called agent to perform some service on their behalf, giving rise to agency relationship. From financial management viewpoint, main agency relationships arise between shareholders and managers and between shareholders and creditors. Agency problem between shareholders and managers. Most agency conflicts between shareholders and managers arise because managers in several large firms own a very small percentage of firm's total shares. This causes a number of managerial goals which are in conflict with goal of shareholders' wealth maximization to take precedence. A moral problem may also arise because managers acting as agents of shareholders may undertake actions using the delegated authority which are in self-interest rather than in the interest of shareholders. Agency costs are costs incurred by shareholders to minimize both agency conflicts and moral problems. Mechanisms which shareholders commonly use to ensure that managers pursue the goal of shareholders' wealth maximization instead of any other conflicting goals are appropriate managerial compensation plans, direct intervention by shareholders, threat of firing, and threat of hostile takeovers. Agency problem between shareholders and creditors. Shareholders, in order to maximize their wealth, may act in a way causing the firm to invest funds in risky projects which cause instability and fluctuation in earnings, sell assets which were safe backups for creditors, and borrow additional funds which increase the riskiness and chance of default for both existing and new creditors. However, these actions are in conflict to interest of creditors. Thus, managers being agents of both shareholders and creditors should act in a fairly balanced manner. They should ensure that legitimate claims of both parties are protected and fulfilled. In this module, we have learned that capital budgeting, capital structure, dividend decision, and working capital management are major financial decisions. Each of these involve risk return trade off. We have also discussed the role of finance manager in an organization, how finance function is organized, and the various agency problems that may arise in an organization.